Welcome back. I'm Pierre Daly, managing editor at advisoranalyst.com. Joining me today is Aubrey Basdeo, head of Canadian fixed income at Guardian Capital LP. Aubrey, welcome to the show, and thank you so much for joining me today. It's been such a dramatic period. I'm very excited about our conversation today because in light of all that's happening, and of course, getting your take on all that's happening in the economy, rates, the bond market, and your fixed income strategy.
It's a pleasure to be here, and I look forward to our discussion.
Yeah, I after just over the course of the weekend in preparation for our conversation today, I was taken aback by all that was happening, and I thought, wow, it couldn't be the most perfect time to have this conversation with Aubrey. He's going to have a real take on it from the bond market perspective, and so Silicon Valley Bank. I mean, and it's not just Silicon. So it's not just Silicon Valley Bank. It's Signature Bank. It's
correct.
Silvergate. I mean, three breakages. In the context of the Fed breaking things with its rate hikes this past year. What do you make of that?
Well, I think there are a few commonalities here across these three. The one thing that really sticks out is the deposit base was very concentrated for all three of these institutions. And it was also very, not just concentrated, but, the customers there had very large, significant deposits to a large extent. So when you're faced with one of those customers moving, their deposits are cashing it out and doing whatever they would do with it, then you have to sell assets in order to provide the cash. And that seemed to be the problem here. And in Silicon Valley Bank, the customer base was largely VCs. But the other part of this for the other two banks were that they were bankers for the crypto folks.
Right. Yeah.
Who can be very flighty. And so that seems to be one common feature here with all of these. And clearly the risk, once this started to play out, the risk is that it could end up being lend itself to systemic risk across the system. So we've had to act pretty quickly here.
Yeah, I'm curious to find out. We're going to talk about it. I think we're going to get to it, and but it's obviously going to change the outcome of the Fed meetings and policy. It's going to tilt things in the opposite direction, I'm guessing, and I'm going to let you talk about that when we get to it. But so quite a weekend, lots to talk about. Before we get started, Aubrey, I'd like to introduce you, even though I suspect most advisors know who you are. But for those of you who don't know Aubrey is an absolute veteran, is one of the pioneers of modern fixed income management, having had long and fruitful tenures, most recently 14 years at Blackrock, which is today the world's largest asset manager, as managing director of fixed income strategy, which includes also his time as principal portfolio manager at BGI, Barclays iShares, which was subsequently acquired by Blackrock. And prior to that, Aubrey was portfolio manager and head of the macro rates relative value fixed income group at Ontario Teachers Pension Plan. What you may not know is that the groundbreaking work that Aubrey and his team did at BGI, at iShares, eventually became part of the bedrock of what Blackrock does today in fixed income. Aubrey is known for being a trailblazer in the very complex world of modern fixed income management, and how appropriate it is that he joined Guardian Capital LP, considering Guardian's own trailblazing across the Canadian and global financial landscape.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Did I miss anything, Aubrey?
No, I think that's a pretty good summary of it. Yeah.
Good, good. So Aubrey, before we get to your take, before we get to your take on fixed income and bond markets, tell us about your time at OTPP and subsequently your time at BGI, pre and post the Blackrock acquisition. What was that like?
A lot of learning. When I joined Ontario Teachers, I was coming from the sell side of the business to the buy side of the business. So a different mentality where, on the sell side of the business, it's minute by minute reaction to, when you get to a plan like Ontario Teachers, you're very much focused on thinking longer term, how you're managing the assets relative to the objective of providing, meeting the obligations of the plan for its stakeholders, and that involves thinking more broadly about risks, how you manage those risks, etc. So foundationally, from from Ontario Teachers, it was broadening out my experience across global markets from when I was on the sell side, very much focused on the local Canadian market. So I enriched myself, my experience, and built up my toolkit, so to speak, when looking at global markets, which was the big focus for me at Teachers. Excuse me. And then when I moved on to BGI, although my role there was to head of the Canadian portion of BGI's business globally, the plan was to deliver a global perspective to Canadian investors. So bringing global solutions or global returns back to Canada, because Canada is a very, very small portion of the total fixed income, the global fixed income markets.
Right.
And the bulk of the opportunity set really resides outside of Canada, given 97% of markets are away from us. So again, that was additional access to other markets, understanding how other markets work relative to Canada, being able to apply a new set of tools, given that BGI was, global in its footprint and starting to do really innovative stuff in order to, in part borrowing from what it was already doing in the equity side and trying to look at fixed income markets in the same way.
So what was there was some cultural differences between BGI and Blackrock. So when Blackrock acquired BGI, how would you define those differences?
Yeah, we thought of it like, so at BGI, our philosophy was looking at markets using what we call a scientific approach to analyze markets, meaning that we try to be very systematic in our approach in identifying opportunities. And one of the things that we felt very strongly about was any individual that was looking at markets would be swamped by the amount of data that they would need to look at first, because, it's for you to do a really good job, you need to assemble a lot of data and be able to make sense of that data. So the best thing to do then is to look at it from the perspective of if you can build models around being able to analyze this data in a systematic manner, you could source yourself an advantage in doing so. The other point about that we felt also very strongly about was any individual looking at information would be looking at it with some inherent cognitive biases. So it's always difficult to remove those biases, given we're human beings. We're built a certain way. That's what's going to happen. And there's not necessarily to say there's something wrong with that, but more often than not, these cognitive biases, because they're they're subconscious. You don't know that you're applying them, that it sometimes will lead you to the wrong conclusion. So we felt that we'll let the models be able to sift the data out, produce an outcome, and then the portfolio manager can look at that outcome and try and make sense of it. Does this make sense? Is at the end of the day what we're trying to say to ourselves. And then we would say, okay, yes. And recognizing as well that when you build models, sometimes there are going to be certain exogenous things that it doesn't understand, such as, bank run, for example. So you have to look at the output and, okay, now I need to incorporate this because the model can't quite understand what that means, right? So that's the approach we take. Now, Blackrock was more of a they took a more fundamental approach to how they make decisions about investments. So we had, on the one hand, the scientific approach, and then we had this fundamental approach. And what we felt was we could learn from each other. So we didn't want to say to one another, okay, you got to use my way of doing it, and we will abandon what you've been doing, right? So Larry Fink, to his credit, said, look, there's a value proposition on both of those. And to the extent that we can somehow marry those two things and take the sort of the best of both worlds, then the firm would be better for it. And so we're allowed to coexist and exchange information with each other. And so, in the end, that proved to be the right decision.
Very interesting. And I mean, I know there's a question I wanted to ask you about technology, but I'm guessing that has a lot to do with what you're doing at Guardian Capital now. And that's bringing the technological edge to your systematic investing strategy with you from your experience at Blackrock.
Yeah, absolutely. I think one of the changes we noted, or the evolution in the Canadian marketplace, is that we're moving from one in which there was a vacuum of data to now the market's recognizing, or investors recognizing, that they really need data to make decisions about where they choose to invest. Now, in the US and in Europe as well, there's an abundance of information, and that information is available to participants. So you can use that information. There's a lot of it, and you can use that information, as I said, to help make your decisions. Canada is gradually moving to increase transparency because it serves investors best that way, but it also helps to lower transaction costs. More transparency you have, more information you'll have at your disposal, and you're just going to be better off as a result. And so we've been pushing towards having more transparency. So moving to electronic trading, in which information is going to be readily available, gives us the same set of tools that we've applied in non-domestic markets. And so I think we're just going to be better off as a result of that.
Yeah, I'm curious because you mentioned it just a moment ago, which was that, when something like a dislocation happens, like this weekend's collapse of Silicon Valley Bank and it's, the ramifications of that, like how it trickles through the market in terms of sentiment. We saw, like, for example, today, big swings in the 10-year and the 2-year, and given that the Fed reacts to the 2-year, tends to focus on the 2-year treasuries. How do you, if you're using a systematic model, how do you take these events? How do you incorporate that into your strategy when it happens? Because it's ad hoc, right? It's not it's not part of the regular flow of data or regular flow of markets. It's a disruption.
Exactly. Yep.
And so
you have a jump to you have an event risk, and markets kind of reprice in a jump function way. And so what you're looking for now, all right, historically, when I've seen something like this, is there a pattern that I can discern? And you're trying to marry that up to what you see today. So, for example, 2008 might come to mind in terms of bank failures, what the markets did, what was the reaction function from the Fed? How do I interpret that, right? So you're quickly and this is the ability of having technology in play. You're quickly trying to, or you should be able to quickly assess that information in some context that will not necessarily give you the answer, but help you be able to decipher, okay, what are the probability outcomes here, right? I can assign various probabilities to, okay, the Fed next week may pause, or the Fed may go by 25, or the Fed may go by 50. So you've got a range of outcomes that you're going to have to assign a set of probabilities. So the market is now suggesting that the Fed is likely on holders. I think there's even odds at this point in terms of whether they'll go or not. Mm-hmm. And we still have data this week, CPI, PPI, retail sales, that will also add more volatility to those probability outcomes as well. But the key point here is that if you've got data, you can try and make sense of it and assign, and then make an informed decision, in other words, here, as opposed to trying to sort of reflect back in your mind what's been happening. How do I, your own experience, and trying to sort of decipher what that is. We'd prefer, as I said, to be able to use as many tools as we can in order to make a better informed decision. And the edge, as you suggested, is having technology assist us with coming up with a better decision.
Right. So you would be using the systematic approach that you've built in order to sort of neutralize any bias, so that there isn't any you're not having a disproportionate reaction in any direction. You're just taking the information as it comes and then acting on it, but not in an emotional way, not right.
I think that's a really good way of saying you want to remove the emotions out of the decision-making process and just be informed by what the data is telling you. So you're looking at the change in the shape of the yield curve. How does this relate to other historical precedents that might look that you might look to as an example of a similar event, the kinds of risks that you could be exposed to by making one decision or another, et cetera. And I think that's, for us, is very important for us to be able to assess, the range of outcomes and how do we assign probabilities to those. And that's much better done by using technology to derive those outcomes. You also have, you have to understand, like, there's no run on a bank here, but we're obviously being sideswiped by global events. Right. Canadian financial institutions are being assessed in sort of a similar way that, a more harsher regulatory regime might ensue from here. What does that mean for banks' earnings, risk premia associated with bank debt, et cetera? So you can see how you need to borrow information from other markets in order to be able to, assess how things might unfold here in domestic markets.
Yeah, I think this event this weekend certainly makes a lot of room for some fear that it's has the risk of making even more room for moral hazard. Because if everybody thinks that the central bank is going to step in and make everybody whole, or at least the depositors, then that leaves the bank or banks themselves to be able to take even more risk down the road. Maybe not right now, but down the road, it has knock-on. I mean, all these things have these knock-on effects, right? So you just.
I think, so there are a number of things here that surfaces immediately. One is, because of the implied Fed put looks like it's back in, given their assurances to depositors. And, in addition to the other step that they've taken about providing liquidity to institutions who find themselves, in need of being able to use an emergency facility in order to meet deposit demands. So
because now everyone's sitting there wondering like how much losses are you hiding in your balance sheet?
yeah,
right?
the market though has a good way of sniffing that out, Pierre, because I think we've all seen what has happened to regional banks, right? They're getting the stocks are getting drilled, and so there's clearly
they're getting their assets handed to them.
You can break that up into two, like exactly. So it would, I think it would be a naive statement to say that you could go back to, this is back to where we were, maybe a decade ago, that, the Fed's going to protect us. We can go out and do things. I would say it would be very difficult for them, because I think you would have to assume that the regulators would now look to reinforce, put stop gaps in place, in other words, to ensure that the issues that surfaced here more recently are going to be avoided, or they'll be able to avoid those going forward. Now, you're plugging one hole. Is there another hole that might, pop up? And that's to me. Sorry, go ahead.
Go ahead. No, you go ahead. Go ahead.
That to me is, one of the considerations, because, we were finding this issue about, as I highlighted earlier, the commonality around these three institutions is a concentrated deposit base. The other would be a very major issue was risk management practices at these three institutions. It doesn't seem to have been something that's very rigorous, given, this mismatch in their funding. So they had very short deposits, so they're borrowing short, lending long, and that gap seemed to be very wide. And, they could argue maybe they were caught offside by how aggressive the Fed was in raising interest rates, and didn't give them enough time to sort of react. But the Fed was so transparent in what it was doing, I can't buy that either. So I think risk management is something.
Yeah, you've got on one hand, you've got the Fed being blamed because at the end of 21, they were saying they didn't foresee, or at the end of 21, they didn't foresee raising rates for quite some time. They were still in that transitory muddle, and then so some folks are saying, well, these treasurers didn't, they took it at face value and went ahead with their plans to invest in longer duration.
Exactly.
And then, but the counter argument to that is, when you saw that rates were rising throughout the year and that inflation wasn't slowing down, and neither was the Fed, or neither was central banks anywhere where this is happening, including Canada. You saw the rate hikes coming. You saw the duration part of your, the longer duration part of your portfolio being impacted. Why was nothing done even at that time, or 6 months ago, or May, or, the summer? So that's where, there's a suggestion of moral hazard taking place, which could easily be relabeled as malfeasance, right? Or negligence,
Right.
Don't know.
And I think critically, what was the incentive system for the executives who are running these institutions to not do the right thing, right? So,
that all remains to be seen. And by the sounds of it, there's going to be some pretty lengthy investigation into all of this. So
yeah, and one of the horrible ironies by this is that Barney Frank was one of the board members for Signature Bank, and obviously he's one of the architects of Dodd-Frank post the GFC. So that highlights for me something that gets to the other point that I want to make about one of the commonalities here is that where was the regulator in all of this? Like, where was the San Francisco Fed overseeing SVB? Why were they not looking at this funding mismatch, knowing that the Fed one part of the organization was raising interest rates, and the regulating side need to have been completely aware that, okay, here's a potential risk in the system that they need to be very vigilant in monitoring.
Well, even the auditors missed it. KPMG gave SVB a clean bill of health. I think a few weeks ago.
Yeah.
So when you have the auditors signing off on it and the regulator doesn't see it, and what it takes rumors and depositors deciding to yank their funds out very quickly, like $42 billion on Friday or Thursday or Friday.
Yeah.
$42 billion at once is unheard of. And the reserve ratios at the banks just can't support that kind of withdrawal either, right? When you don't have any contingencies in place for that kind of anyway. We're not here to get into the weeds about SVB, but what I do want to get into with you is now, what are the repercussions? We talk, there's a probability now that the Fed, Bank of Canada already paused, right? Last week.
Right.
That was a big deal. I think it was a Schwab commentary called it is that a trailblazing move? Right. And should the Fed be paying attention to that too? Like if Tiff Macklem decides it's time to pause, we don't want to break our economy by just continuing down this road blindly until something does break. And then it's uncanny because the breakage that the Bank of Canada was afraid of, well, it's happened, right?
No, exactly. Yeah.
So now what are the chances? Like you did mention the chances of a pause, but if there's more breakage to come or more cracks are revealed in the armor, what does that mean for, I mean, it's not good. None of it's good. There's certainly no,
right.
I don't think there's no joy in talking about it. It's just fascinating that it's happening.
It's a cost benefit analysis that I think Fed has to try and figure out here. So there are two very distinct things here they could argue, and still, so on next Wednesday they could hike by the 25 basis points, let's say at a minimum that they had been articulating that they still need to get to a higher terminal rate than the market was anticipating, and in order to fulfill their mandate of inflation at 2 and full employment. So they're very focused on the inflation side of the equation. So they could go ahead, be very clear what they're doing on that side of it, and at the same time be very clear about how they're handling this potential issue of trying to mitigate bank runs on regional institutions. Now, in theory, that could work. In practice, trying to convince investors or the populace at large that you've got this under control and all of this, if I can isolate these two things independently, and I can act because I've got tools on one side and tools on the other side, appropriate tools to handle each one of those objectives, then I'm good to go, right? So you can do that. I don't believe that's how markets will work, and so that's why they have to think very carefully about the costs and benefit of doing what they're trying to achieve, which up until now was getting inflation under control. So could you argue that what is going to happen here likely will be a natural tightening of standards or financial conditions in the U.S. economy? So in fact, you've now seen that will play out, and you'll achieve your objective without having to do anything more.
Yeah, it certainly looks that way. if you just listen to the tech people talking today, like it's going to become even harder for venture capitalists and tech companies to raise money.
Absolutely. I think definitely I would expect that at least for the next 6 months to a year, that there's be a lot more caution about, allocating capital to VCs at this point, because, you'd want to see how the dust settles at least before you make any additional.
And now if the regional banks, like, in the wider scope of this situation are also facing similar dilemmas with their reserves available for sale, held to maturity reserves, if they're facing scrutiny and they're facing regulation, that too will force them to increase their deposit rates and
right. Yeah.
tighten their lending conditions as well, right?
Exactly. So, I think that at least should be sort of given a high probability outcome here. Just a natural tightening we should expect, because look, as an investor managing, portfolios for clients, I have to sit here and ask myself, okay, what's the assessment I think about risk premia if I'm going to go out and add risk to the portfolio? And I certainly wouldn't be thinking this is the end of it. It's bargain basement. I should run out there and buy stuff. I think I'm going to wait to see how things manifest itself, and then try and decide when is the appropriate time. But there's just going to be a lot of volatility in the near term. Best to stay on the sidelines and at least pay attention to the risks that I have in the portfolio and monitor those carefully to see if there are any unintended risks that I have that I need to neutralize, and the risks that I want to take advantage of, whether they're appropriately priced or not, and take the appropriate actions in order to mitigate those. The thing about getting back to the tightening of lending standards, so we have a potential run on a bank. The Fed has said, okay, here I'm acting decisively. So Janet Yellen's come out and said, basically, not on my watch, nothing's going to break here. So here's what I'm going to do. And again, which we've said, could give a false impression about, the Fed is there to bail you out anytime something bad happens. So this issue of moral hazard comes into play. But I think what may happen that they have to consider, and this is what they're trying to get in front of, I think, is to the extent that folks are worried about their deposits at a financial institution, because, JP Morgan is not in every single district throughout the US. You keep your money under the mattress. If that is what's likely to happen to some extent, then they have to be worried about an acceleration towards a very sharp slowdown in the offing here somewhere, by the end of this year. And so that's a big risk at the moment that they have to keep assessing. So it comes back to the question about, do I pause? Do I go by 25 basis points? That delicate balance now is in play, and just more volatility because of the potential outcomes is what we're going to be faced with.
As head of Canadian fixed income at Guardian Capital, how are you approaching this? Is it safe to say it's too soon, or do you have a set of are you looking at the situation and have you made decisions already, or trying to make decisions about how to go forward, given the new, because it's not a binary situation, and as you said, it's going to be volatile, because there's going to be the ongoing flow of data with this boulder of SVB and the regional banks in the middle of the river and everything flowing around it, right? You're going to have this, like, how do you navigate from here? What's the, what kind of strategy are you considering right now, given the, these variables?
Okay, so let me take a step back here and give you a sense of how we're looking at this. When you're investing in the fixed income markets, you have to have a good sense of the macro backdrop. And when I say a good sense, everybody has their own interpretation of how things are likely to unfold. We meet twice a week. The team does, and where we're updating ourselves on what are the factors that we're paying attention to and what's the probabilistic outcome from a macro perspective that we see. So broadly speaking, we're already thinking that there is a slowdown unfolding. When we look at leading indicators in Canada and the US, that's what is in front of us.
Right.
Coincident and lagging indicators such as employment and some of the soft data, sentiment, and things like that are suggesting, particularly employment, are suggesting the economy is still healthy. Employment is a lagging indicator. CPI is a lagging indicator. And so while we will acknowledge that there's still some economic momentum, long and variable lags to monetary policy suggest to us, and as evidence, as we're looking at some of the leading indicators, are saying that things are slowing down. Right. Credit card balances are building up, etc. So all of this points to us that there was going to be a slowdown, absent this event risk that we saw this past weekend. Add that to what we are already sensing or seeing, suggests to us that it's going to be more pronounced. How much more pronounced is what we're going to have to monitor going forward. So when we see that, you're beginning to think about your portfolio construction, about the opportunity set in front of you. What's the Bank of Canada likely to do? What's the Fed likely to do? Because obviously we're somewhat tied to we're very tied to their economy. This would suggest to us that if we were thinking about short duration exposure, we would be thinking about lengthening our duration somewhat at this point. If we were thinking that curve flatteners were still the way to be for now, we would be thinking about curve steepening as the way to go from now.
Right.
Right. Now, clearly, the market went very steepener-ish today, and so we'll let the dust settle there. We were already positioned for a steepening bias anyway because of, as I said, we were anticipating this slowdown, a turn in monetary policy, etc. It's just accelerated that now to some extent. In terms of risk premium itself, so if we want to own provincial bonds or corporate bonds, I think it now becomes ripe for looking at individual corporations and being able to suss out, where the dispersion is, what's value, what's not value, etc. So we quite like what's in front of us because we thrive in that environment where there's more dispersion, because we feel we have the tools to be able to identify the opportunities that are in front of us. So we're likely to be quite active, ahead of us now, and even more so than we were anticipating because the environment has changed. I would say radically might be a strong word at this point because we just don't know how much as yet, but we certainly think, we're leaning definitely more towards that.
Well, I think, at the very superficially, this event confirms, it confirms what many folks, what many investors, many people in the market were thinking for quite some time since, you start to see data rolling over, that there was, at the very minimum, things were going to be disinflationary. But now I think what you're saying is that it's deciding, is it going to be disinflationary, mildly disinflationary, or deeply disinflationary, or is it going to be even possibly deflationary?
Or you could argue that, if anything, because of the loosening of financial conditions vis-a-vis these emergency programs that they've enacted, that it could spur activity because now you've given everybody a free rein to go out and do stuff, right? But as I said, I don't think that's the likely outcome. So I think what we'll see is that once we get past this week's CPI in the U.S., that we will resume a more accelerated trajectory in the decline in CPI going
Right.
forward into year end. Now, I don't know where the landing zone, where the destination is or rather, I should say, we know what the destination is. The Bank Canada wants 2%. But for this year, I don't know where we land. My guess is somewhere between 3 and 4%. But I could certainly make the case that we could get to 2% now, given, how much things might potentially contract from here. So, with that, that's the trajectory in which we see, at least for the remainder of this year in terms of inflation headed. I do want to make this point, though, that our belief is that we are entering a new regime going forward, that we're exiting zero interest rates, easy policy or easy financial conditions. And we're likely to see higher inflation going forward, higher volatility going forward, and a higher terminal rate going forward. But it's not going to be immediate. I know, like the next 10 or 20 years, we're certainly going to be looking at a very different dynamic relative to where we were in the past 20 or 30 years. And as I've said, I've indicated some of those characteristic features that we're looking at. So the bigger macro backdrop is towards this new regime that is we're going to be paying attention to. But the here and now, the immediate future, the next quarter or two, is going to look a little similar to what we had coming out just pre-COVID or going into COVID. And the Fed has clearly indicated their willingness to do certain things that, quite frankly, we'd anticipated they wouldn't embrace as readily as they did today or over the weekend.
Yeah. So would you call that inflation volatility, where inflation, like we've had this inflation spike now, the one that's come and gone, and or looks that way. But then with the inflation volatility comes the need to also constantly manage or try and manage the yield curve, right?
Absolutely. Yeah.
Yeah.
So the driver for inflation, we think, is going to be, we've gone from a period or regime of abundance of...
The terminal rate won't be 5.5 or 6%, right? It'll be a lower terminal rate over time.
Lower terminal rate over time. If we think of, the rule of thumb would be that if you think inflation is going to be somewhere between 2 and 3 for the long run as opposed to 2, so let's pick a number 2.5. So what should a real Bank Canada rate be, or a real Fed funds rate? And so should that be an additional spread of 100 basis points? Historically, that's kind of the number has been. So you're looking at 3 to 3.5 as kind of the terminal rate. Now, again, that is anchored around, inflation being around that zone. And we have to believe that central banks' credibility is at stake here. So they need to get that down. But working against that objective, because remember, the U.S. has a dual mandate of stable prices and full employment. Well, in this case, if you're going to have somewhat higher inflation that you're trying to suppress, you're going to have to give something up on the other side, which is going to be lower growth, meaning that potentially the labor market may not achieve the second part of your mandate, or be more difficult to do that. So what potentially could keep inflation higher than they're anticipated? Well, we're looking at, as I said, this new regime. One characteristic feature of which is becoming evident is this fracturing of our global economy. So we've went from globalization as being kind of the dominant feature, which led to an abundance of supply, both in terms of labor and material, to one where the fracturing is now challenging that abundance of supply. So we've seen some evidence of nearshoring, reshoring, or offshoring to more hospitable countries. That'll take some time to really evolve, but that's in play. And so with that effect, cost of producing something is just going to be higher.
Right. And then it'll be flowed through back to us.
Exactly.
Back
And
to
so,
consumers. Yeah.
And the consumer in the end will come back to its employer and say, look, I can't live on these kinds of wages, so something has to give here, right? So this is not going to resolve itself in the next couple of years. I think it's going to be quite a while before we come to sort of that happy state. And again, we don't know. That happy state means inflation is at 3 or 2.5 or whatever that number is.
But in the meantime, it's inflation volatility. It's
correct. Yes.
And what Aubrey, what do you think are the odds that the Fed, overshoots? I mean, I think they've gone down dramatically, but just with this week's this week's events. But what are the odds that the Fed overshoots the 2% target? And we're by overshooting, obviously, we're back to where we were the last decade.
Yeah.
Yeah. I mean, I know, like given the deglobalization, right? It's so strictly a probability question. What do you think are the chances that happens?
So I think I would give that a small probability that they could reverse the forces back to the levels that we saw during pre-COVID. And when I say small probability, I don't mean it's insignificant. I just mean that I just don't see, given the other factors that we've just described in terms of the fracturing of global economies, competition now, between China, Russia, and the Western economies. That to me suggests that, it's just going to be very difficult. There's going to be more friction in movement of goods and commerce. For them to they can certainly get overshoot inflation on the downside, but that would mean you're going into, at least from my perspective, a deep recession. And that means that the other part of your mandate of full employment, you're sacrificing that in order to get there. Politically, as you're going into an election year, I find that the Fed might, not that they will play around with their credibility, but will tread very carefully in terms of looking like they're sinking one administration to the benefit of the other.
Right.
Politics does come into play. We have to acknowledge that for the Fed,
for sure,
and they can they want to stay above that fray. And
so in a way, this week's events might serve that.
Exactly. Yeah. It buys them some time, but it's still their only currency is credibility, and if they screw that up, they're going to lose in a big way that the market's just not going to believe what they say they'll end up doing. And that just adds more volatility to markets overall. And so, again, it gets back to my point that be prepared for more dispersion. Beta exposure is not the thing to have going forward. It was the thing to have when the Fed is saying, I got your back, don't worry. Yeah. You can go out and buy risk assets, and if things look like they're going to soften up, I'll be there to assist you. And that worked beautifully. But going forward from here, I think active management is going to be critical to be able to, meet your objectives, but manage portfolios in a way that can mitigate some of these things like you have had over the weekend.
So, Aubrey, what's the way forward here, like for fixed income, for Canadian fixed income investors? What is the direction now? Given everything that's changed, ballpark, not you don't if you don't have to, you don't have to give away any trade secrets, but
right. You need to pay attention now more so than you did in the past, because a bunch of there's a good and there are pluses and negatives here. The pig in the python, when I think about demographics, right, it's the baby boomers. That's kind of the bulge of, the pig moving through the python in terms of demographic profile. The youngest one of the baby boomers are now in retirement age. So their focus is on income. And, today, if you can get a risk-free investment at 5%, you should be quite happy about that.
Absolutely. Yeah. That was the big dilemma for the longest time.
Exactly.
You couldn't get even you couldn't get your 4% out of, but now we've got, anyway, sorry, go on.
Yeah. You've got 5% and you're thinking this is great. But the other side of the equation is you've got risk assets, that if you own overnight or money market stuff, it's not going to provide that ballast to the portfolio that you need.
Right.
So you have to now be very selective so some of your assets definitely, in terms of how you think about a portfolio construction going forward, having that cash equivalent earning at 5%, but you need to think about the rest of the portfolio, that fixed income, how does that provide diversification to the overall portfolio construction that you have, and having that exposure is going to be critical to dampen the overall volatility. We're beginning to see, so over the past 30 years, there was a very strong positive correlation between across assets. So fixed income and equities move more or less in tandem with minor interruptions. That's not how, it's supposed to work. We're supposed to use fixed income as a way to diversify our exposure in the portfolio. And I think we're just beginning to see that negative correlation start to play out now. And that's how I think we'll see. So again, getting back to your point about what's the opportunity set, it's really thinking about how do I use fixed income in order to help mitigate the risk in the portfolio, while at the same time will generate an adequate return going forward. So I think you'll do fine. You need to pay attention to the duration of the risks that you're taking from a fixed income perspective. And to some extent, the market is helping you sort that out, because as rates have risen, duration has gone from about 8.5 to 7 and change. And so to the extent that we continue to see modest increases in interest rates, it'll recalibrate that. But you've got choices between short duration, the mid part of the curve, or the universe as a way to think about getting that balance in your portfolio appropriate.
Right. So I think you covered, I think you've covered what really the big challenges are, which is that if you like, for the last while anyways, investors, advisors have been hugging the shorter end of the curve, because it just, it made sense on so many fronts, given last year's volatility and drawdown in the markets. But now, of course, we see this opportunity set unfolding. And what do you think is an appropriate, like, I don't think anybody's out there with 100%, of their fixed income sleeve sitting in short-term instruments. But in case they are, just in case they are, because of the duration risk that was there before this quarter, what would be, would you suggest, like that, wading into duration is the way to go, or?
Yeah, that would be the right way of phrasing it. I think start to think about adding some of the duration risk to the portfolio. The combination of capital gains and income, that to me looks to be a high probability outcome going forward. And again, I really want to emphasize the dampening of volatility that solution would provide to your overall portfolio. Is something that is the added benefit that you will get. So waiting, I think, is the right approach. A day like today might make waiting seems like,
Yeah. An impossible choice.
yeah, exactly. You need to be there immediately, right?
Yeah.
But I think, it'll take some time for this to settle itself out. We've got all these meetings in the near term in March and May and June in the US and in Canada.
Yeah, and today's reaction was quite visceral. I mean, it's not necessarily that it's going to stick, that the 10-year is going to stay at 3.5. It's probably there's probably as much a likelihood that it will drift back up.
Exactly.
Yeah.
Equilibrium is, we're trying to sort that out now, and it's going to be, the market, I think, will be very reactive to it'll be an asymmetric bias in the short term. Weak data will see a much bigger reaction than strong data. So even if the CPI is strong in a relative sense to expectations, it'll get a more muted reaction than if it were weaker. It'll certainly see a bigger reaction because the market will assume the Fed is now done and, clear sailing ahead in terms of, what the next turn in monetary policy is likely to be. And not until we get past all of this kind of short-term gyration or volatility where we sort of get a better sense of what the landscape looks like. But as I said, from my perspective, I think this event risk here has done some of the heavy lifting, will do some of the heavy lifting for the Fed and global central banks in general in sort of muting demand and trying to get that better balance between supply and demand going forward. Notwithstanding that, I still have to emphasize, the external risks that we face, i.e. Russia and Ukraine. Who knows? Yep. That's something that we have to keep monitoring. China aligning itself with Russia. How does that play out vis-a-vis Taiwan, et cetera? So there are these event geopolitical risks that I think difficult to hedge, let's put it that way, because you never know what's the outcome is going to be. But the sort of the undertow to the economies are simply going to be that tightening of lending standards, tightening of financial conditions vis-a-vis something like what has happened here, in addition to what the Fed and Bank Canada has been doing, is simply going to continue to reinforce this stronger undertow, to suppressing growth.
So start wading into longer duration fixed income again.
I think, that makes sense.
Yeah. And how does that happen? How is that happening within your mandates, within your portfolios that you manage?
Well, we're managing to very specific benchmarks. So short duration would be 1 to 5 year exposure of the universe. And we keep our duration targets within plus or minus half a year. So we're not taking very large duration bets per se. What we're trying to do is build a portfolio that we think will outperform by making sector selection, security selection, and positioning along the curve as where we spend all that risk budget. Similarly for the universe, we're not making big duration bets on it. We think we can outperform by doing similar things as I explained on the short duration profile. For an investor looking at, if I'm mostly in cash-like instruments and I'm terming out in duration, my tolerance for short duration or universe or the mid part of the curve is what I need to think about. So an advisor needs to contemplate, where do they think they can best land in order to, again, as I said, think about dampening the volatility in the portfolio and earn a reasonable or respectable income out of that.
Excellent. I ask you because I don't think advisors or investors actually want to do a lot of fixed income management because of the complexity. And then of course, trading individual bonds, but there's obviously, a multitude of solutions in the marketplace. But I think it helps to know how you're doing it. Your thought process around how to, how to structure a portfolio along the yield curve, and making sure advisors understand that that managed active solution is available to them is above all the most important thing for them to know.
Absolutely. And I think just reemphasizing the point about regime change, passive served you well over the past 30 years, but environment of higher vol, as we expect, more dispersion, active management, I think is the right approach going forward from here.
I spent 15 years as a retail advisor, but it was only after I left retail, and I feel like I don't know that that's true for all advisors. I don't want to, I'm not painting the industry with that brush, but I feel like I always had only a limited amount of time as an advisor to learn, the true complexity and power of the bond market. Not only as a diversifier in portfolios, but obviously as sort of the ruling power in markets. So, I mean, it's been great talking to you, Aubrey. I was looking forward to this conversation for all that it's been. I think you've pretty much answered, the key questions. But I wanted to ask you in parting, what are some of your most memorable experiences or lessons learned from your career?
There are three that I'm going to highlight, and it always reverberates in me when something like this happens, what happened on the weekend. And not in sort of the order of importance, but number one would never underestimate how quickly liquidity can dry up. You may, prior to Thursday, let's say, you might have thought markets, I can do anything I want. And then, 2 days later, in our morning call today, it was highlighted that, the market, you could show a bid, but you could not find an offer, or vice versa. So it's almost like you could snap a finger and liquidity could go away. So you always have to, when you're constructing a portfolio, think about, what's the liquidity environment in terms of the assets that you put in the portfolio. How could they survive if you're called for liquidity? So in case, this extends, naturally to the way these banks were being managed, because the liquidity profile wasn't stress tested enough, in my mind, to ensure that they could, handle any kind of dramatic drawdown in their deposits. So that's it. Number two is always pay attention to value. Like, don't deviate from that discipline, as Warren Buffett will say. You're always looking to buy something 50 cents on the dollar. Like, don't overpay. Just be patient, right? So just keep assessing what the appropriate value of something is and stick to that. And the third is always be patient. You're investing for the long term, and you're going to be, so if you don't get the price that you're looking for, it'll come back to you at some point. So you just need to be very, very patient. I think if you stick to those three, or at least for me, I've stuck to those three kind of overarching principles. Don't remember liquidity is a driver, and you can't underestimate how quickly that can disappear. Always, know what you're paying for value, and be patient. So that I think will serve you well.
Thank you, Aubrey. That's wonderful. I was, as you were saying that, I was thinking, I wonder, given last week's very passionate Fed meeting, where they reiterated their drive, with, to continue raising rates,
right.
A day later, this situation happens, right? But, and then given days like today, where you could easily see where, some investors might have that FOMO appetite back, or react in a way about, fear of missing out. You're absolutely right. Being patient is definitely a worthwhile endeavor. Thank you so much. That's our conversation definitely exceeded my expectations. I want to thank you so much for your incredibly valuable time.
My pleasure, Pierre, and happy to be a part of this.